In today's video, I'm going to show you guys why your stop loss gets hunted and where you should place your stop loss. If you're tired of the market just hitting your stop loss to the tick and then bouncing up, this video is going to be for you. All right, so let's jump into today's video and we're gonna take a look at the NASDAQ. Now you can see on Friday, the NASDAQ came down, tried to bottom out and then finally ran up. And you know, a lot of people, as they're trying to trade near the bottoms, trying to catch the bottom for the move back up, they keep saying the market makers, they're hunting my stops, the banks, yada, yada, yada. That's not the case. I'm gonna show you guys how we can identify it. So now we're gonna come over and look at bookmap. You might say, Mike, what in the world am I looking at? Well, it's gonna be very simple. The lines going horizontally across the screen represent resting limit orders in the market, meaning passive buyers or sellers. And I want to bring this up. If you guys had joined me during my live streams at night when I trade the Asia session, you guys know how I trade these liquidity levels using bookmap. But if we're looking to trade the markets, one of the things we want to do, and I talked about this in Friday morning's analysis video. So if you think I'm making up these levels that I'm talking about, I would encourage you guys to go watch this video in the top right hand corner of your screen from Friday, where I actually talk about this level. But in Friday morning's analysis video, I talked about this level right here. I said the market has already broken through it. But then I said there was another level all the way down here, right around the 450-ish price point, the market could be trading down towards. Now, why is this important? Well, one, if we know where liquidity is resting in the market, one, it ends up acting as a magnet, pulling price down towards it. But also, if we're looking to catch reversals in the market, where do we want to make sure our stop loss is at? And you might say, well, Mike, here was liquidity. The market ran right through it. You are absolutely correct, but I'm going to show you guys how to spot and know when the liquidity level is going to hold and when it's simply going to go ahead and just go cascading through it. So let's talk about the first step real quick. We see this large liquidity level sitting right here, and we're going to look at the 19,500 price point. If we come over and we look at the 1 minute chart real quick, I'm going to simply draw a horizontal line across that first large liquidity order we saw in the market and look at from a candle perspective. What do? We closed below it. Did we ever try to get back above it? The simple answer is no. The market never tried to make it back above it. And this is an example on the 1 minute chart. If you want to see what it looks like on the 5 minute chart, that would be right here. You can see we have a big, nasty candle that just rips right through that area. So regardless if you're trading the 5 minute chart or if you're over here trading the 1 minute chart, we never had a candle even try to get back above that level. That is clue number one. Now here's where it starts to get dicey as well, because as we come back over here and we start looking at bookmap and we know that we've already blown through this level. So now let's talk about how we know this level is not going to hold. You can see we come into the liquidity level, we get a decent size bubble. That means we have a decent amount of aggressive sellers on the tape. The next bubble gets larger to the downside. Okay, that's not showing signs that we want to, firm up here. Now we're pushed substantially below that liquidity level and we get another larger bubble. So from my standpoint, I am not looking to try to play a bounce off this liquidity level. One, we're already too far past it. And number two, the aggressive sellers continue to pound the tape to the downside. So then as we scroll our chart down a little bit further, notice what we start to see. We start to see right here, right around 450 on the chart. So now what I'm going to do is I'm going to grab in this horizontal line. I want to move it all the way down here towards about 450. And I want you guys to pay very close attention. If we look at this on the 5 minute chart, this is what caught a couple traders. Some of you guys messaged me on Friday and say, Mike, I tried to catch the bounce and the market stopped me out to the tick. Why does a market maker continue to stop me out? They see this wick down here. They say, oh, this has to be the bottom. We start to come up a little bit. And as we start to come down, I said, I'm just going to put my stop loss right below the wick of that candle. If we look at when that candle actually closed from a 5 minute perspective, that is actually 8:40 in the morning. If we look out here on the 1 minute chart, that candle actually closes also at 8:40 in the morning. So then as we come back over real quick and we take a look at bookmap, let's look at what we see at 8:40. Well, 8:40, we have this large liquidity. What did the market do? We get a large red bubble, which was that tell us there's a lot of aggressive sellers coming into that level. But what about the second step? Did we get a breach below it and were the bubbles getting bigger as we are going below that liquidity level? The simple answer is no. So from 940 on, if we want to play this area, where would it be smart of us to try to put a stop loss in place? If we're going to simply bounce right as soon as we start taking out the high of that candle, then where do we want our stop loss to actually be placed? Well, it's very simple. We come back over here and we look at bookmap, and what I want to do is say, okay, there was a lot of sellers right here before. So it'd makes sense to me to probably, put my stop loss 1 to 2 points below the low of that area. Now, if we go ahead and we look, why would I want to put my stop loss in that location? Well, one, we knew we had a large buyer sitting there before. So was it the large buyer that caused prices to go back up? And if so, if we come back down towards that area again, that buyer should still be in there trying to protect their initial position unless the market's going to go substantially lower. So if we go and we scroll bookmap back here just a bit, notice that that large order that we had is no longer present. But I also want to bring you guys to a phenomenon here in just a moment. Then on the 1 minute chart, what do we see? The market came up, we came back down, and we tested that level. And look, if you look at the low of this candle, we had a low of 19,447.50. The low that we initially made was 19,448.50. So if we actually look, we went roughly 1 point or 4 ticks below that level. Now, it's always good, all right? It's always in your best interest to see a level that you identify, see it to come back and get tested and then rejected. And that's where we want to get into the market. Now, I'm going to come over to bookmap real quick, and I simply want to draw a horizontal line right where that liquidity level was before. And what I'm going to do with this now is, I'm just going to fatten up this line a little bit just to make it very easy for us to see. So hopefully everybody can see this yellow line going across the screen. Now, I'm going to zoom this out here just a bit, and I want you guys to pay attention. Notice how large that bubble was coming in, how aggressive the sellers were coming into that level. Then I want you guys to see right over here, as we came back into that level, we have a green bubble, which means the buyers were present. There was more aggression. There was more aggression on the buy side for the market to try to push up and out of that area. One, we know the bubble was green, but also look, was it a large bubble? No. So what does that mean? There was a lack of selling as we came back into that level. So from a logical standpoint, we know it's highly probable from that point on, that is where the bounce is going to occur. Then if you look, that ends up being the low of the day and the market continues to rally on up. But wait, now the reason I chose to use this example from Friday was, as I'm recording this video on Saturday over here on August 17th, I wanted to use the most recent data. So the best way to make sure your stops are not being hunted is, first, make sure you identify the liquidity level. Then you want to wait for the valid retest of the liquidity level with less aggressive sellers coming into play. As we come back above that liquidity level, we can enter the markets, put in our stop loss right down below where the market showed us there was very little aggressive selling in the markets. And if you want to play this to the short side, it's the exact same thing, just flipped in reverse. Now, if you like to use bookmap so you can see the markets in a whole new light, there's a link in the description box down below. Use promo code Mike at checkout. It'll save you 20% off your subscriptions. And if you guys want to see how to spot absorption using order flow, make sure to watch this video right here.